The Maryland State General Assembly is in session for 2025, and of course, one of the biggest pieces of legislation they have to consider is the state budget. So several chambers have come together in Montgomery County to oppose the state's Budget Reconciliation and Financing Act. I would like to go ahead and read that testimony to you now. On behalf of the Gaithersburg Germantown Chamber of Commerce, Greater Bethesda Chamber of Commerce, Greater Rockville Chamber of Commerce, Greater Silver Spring Chamber of Commerce, and Montgomery County Chamber of Commerce, we oppose House Bill 352 and Senate Bill 321, the Budget Reconciliation and Financing Act of 2025. Montgomery County's chambers recognize the challenging decisions our budget leaders face this year. We also appreciate Governor Westmore's focus on addressing Maryland's stagnating economic growth. As business leaders in Maryland's largest jurisdiction and a critical economic engine for the state, we share a vision of growing Maryland's economy, creating jobs, and fostering a thriving business community. However, we are deeply concerned about several revenue increase measures proposed in House Bill 352, including a surcharge on capital gains and the elimination of itemized deductions. While these are significant issues, we are even more concerned about the implementation of combined reporting and the creation of two higher income tax brackets. These proposals, if enacted, will disproportionately harm Montgomery County, which has already experienced the migration of some of its taxpayers in recent years. Simply put, these tax increases will create a non-permissive environment for businesses in Montgomery County and across the state. Implementing combined reporting is bad policy. Combined reporting has long been opposed by the business community. It is not a loophole and remains one of the few competitive economic advantages for Maryland. What is frustrating for the business community is that the combined reporting has been formally rejected multiple times. In fact, combined reporting has been rejected by not one, but two separate bipartisan tax working groups in recent years. In 2010, the Maryland Business Tax Reform Commission, MBTRC, which was created to evaluate the state's business tax structure, was explicitly directed to review whether to implement combined reporting. In its recommendation, MBRTC recommended against combined reporting in Maryland. The Commission's final report outlined several reasons for rejecting combined reporting, including its complexity. Combined reporting is a complex change for taxpayers and the Comptroller's Office. Shift of tax burden. Combined reporting shifts the tax burden, substantially in some cases, among industries and taxpayers, resulting in winners and losers. It's unnecessary. Many of the tax avoidance measures which combined reporting is intended to prevent have already been addressed by the state through the Delaware Holding Company Add Back, the Captive Real Estate Investment Trust REIT legislation, and through other measures. It's increased volatility. A comptroller study of corporate returns indicated that combined reporting would lead to increased volatility in corporate income tax revenues, already one of the state's most volatile revenue sources. In 2015, the Maryland Economic Development and Business Climate Commission, also known as the Augustine Commission, issued a report advising against the adoption of combined reporting. The report highlighted that combined reporting, quote, can create revenue volatility and winners and losers among corporate taxpayers, end quote. It further noted that, quote, combined reporting can also lead to additional litigation from taxpayers and create additional administrative costs for both taxpayers and for the state, end quote. Secondly, addressing higher income taxes that hurt small businesses. This bill also proposes creating a 6.25% tax bracket for those earning at least $500,000 and a 6.5% tax bracket for those earning more than $1 million. While intended to capture more taxes from higher earning Marylanders, it will also impact small businesses. Virtually every small business in Maryland is registered as a limited liability company, a sole proprietorship, or an S corporation. These entities are taxed using the income tax rate as a pass-through entity. Enacting higher income tax rates will disproportionately harm small businesses and small business owners by increasing their tax burden, reducing their competitiveness due to higher costs, and directly threatening local jobs and growth. So as a united group of business organizations, we appreciate the opportunity to weigh in on these proposals and urge the Maryland General Assembly to reject combined reporting and higher income tax brackets. Focusing on inclusive economic development and creating a more competitive business climate is essential for balancing Maryland's budget through economic growth. And this testimony was signed by Angela Franco, President and CEO of the Montgomery County Chamber of Commerce, Margie Graff, President and CEO of the Greater Rockville Chamber of Commerce, Stephanie Helsing, President and CEO of the Greater Silver Spring Chamber of Commerce, Allie Williams, President and CEO of the Greater Bethesda Chamber of Commerce, and me, Paula Ross, President and CEO of the Gaithersburg Germantown Chamber of Commerce. Please keep your eyes peeled on our website and on our social feeds for more advocacy. Thank you.